Welcome to The Explainer. Today, we're unpacking the high-stakes world of Goldman Sachs and a recent identity crisis that, get this, cost them billions. It's really a story about the two very different sides of one of the most powerful banks on Earth. Let's just start with this number, $7 billion. Now, that's not profit. It's the pre-tax loss from a single massive strategic blunder. It tells you everything you need to know about ambition, failure, and a huge pivot back to what Goldman actually does best. You see a number like $7 billion, and it just begs the question, right? What on earth went so wrong? Well, the answer reveals a 5-year gamble that just failed spectacularly and forced one of Wall Street's most iconic firms to completely rethink its future. So, to really get a handle on the Goldman Sachs of today, you have to start with its ambitious and, well, ultimately failed attempts to conquer Main Street. You see, for most of its history, Goldman Sachs was this exclusive club for corporations and the super rich. But that business goes up and down, it's cyclical, and the firm wanted something more stable, more predictable. So around 2020, they went all in on a huge push into consumer banking, trying to build a bank for the average person with shiny new products like the Apple Card and Marcus savings accounts. This was a massive, massive departure from their Wall Street roots. But yeah, that whole experiment fell apart, and fast. By 2022, the losses were just piling up. The firm basically started a fire sale, getting rid of the lender GreenSky at a $500 million loss. And the retreat was complete when they offloaded the entire Apple Card business to JPMorgan. It was a total full-scale failure. And the total cost, it was staggering. It wasn't just the $7 billion in financial losses. The firm's reputation took a serious hit. And maybe most importantly, it spent 5 years with its top minds, its biggest brains, all focused on this doomed project, distracting them from what they're actually incredible at. Okay, so with that consumer dream totally in ruins, what is the real Goldman Sachs? Well, the answer lies in the business they never left, being the undisputed kings of Wall Street. Check this out, 32%. That is Goldman's global market share in advising on mergers and acquisitions. Think about that. For basically every 3 major corporate deals happening anywhere on the planet, Goldman Sachs is in the room advising on one of them. And what does that look like in dollar terms? Well, in 2025 alone, Goldman advised on deals worth nearly $1.5 trillion. To put that into perspective, they were the lead advisor on 7 of the 10 biggest corporate deals in the entire world. And this dominance is just crystal clear when you look at the fees they bring in. I mean, in the high-stakes game of M&A advisory, their $4.6 billion in fees just towers over their closest rivals. They're not just winning, they are in a completely different league. But their core business isn't just about advising on these huge deals. They also dominate another absolutely critical area, the trading floor. $16.5 billion. That was their revenue from just the equities trading business in 2025, a company record. You see, when markets get volatile and chaotic like they have been, Goldman's trading desks just thrive, capturing profits from all those swings. So, okay, they've retreated from Main Street and they've refocused on their Wall Street strengths. Goldman now faces a future that's defined by some massive opportunities and also some pretty significant threats. The firm's leadership is incredibly optimistic, really bullish. The CEO, David Solomon, he thinks we're just at the very beginning of a new boom in corporate deal-making. And why? Because there's over $4 trillion in cash just sitting on the sidelines with private equity firms waiting to be spent. But here's the great irony at the heart of their business. The very same geopolitical uncertainty that creates all that volatility, which is fantastic for their trading desks, could also make corporate boards too nervous to sign off on the giant M&A deals that feed their advisory business. It's a real catch-22. So to create more stable, predictable revenue, Goldman's making some big moves in asset management. They just recently spent about $2 billion to buy a company called Innovator Capital. And boom, that move instantly made them a top 10 player in a really fast-growing area of exchange-traded funds, or ETFs, specifically the kind designed for more cautious investors. But, and this is a big but, they face a huge threat from rivals who didn't get sidetracked by a consumer adventure. JPMorgan, for instance, is spending $20 billion on technology this year alone. That's a massive war chest that Goldman, for all its prestige, just can't match. Now, here's a fascinating little twist. Goldman is actively exploring the launch of a regulated prediction market. Okay, think of it like a stock market, but for real-world events. This could open up an entirely new way for them to make money that plays directly to their strengths in trading and risk management. It's a true wild card. So, what does this whole tale of two Goldmans, the failed consumer bank on one side and the dominant Wall Street king on the other, what does it all really mean for the firm's future? The firm's journey over the past 5 years can really be summed up in 4 steps. It started with that big gamble on consumer banking, which led to a $7 billion failure. That, in turn, forced a strategic retreat and finally, a powerful refocus on their core institutional clients. It was a painful path, for sure, but a very clear one. Ultimately, Goldman learned an incredibly expensive lesson about its own identity. Its real power, its competitive advantage, doesn't come from trying to be everything to everyone. It comes from being the absolute best in the world at serving its core market, giant institutions. And that leaves us with the big, final question for Goldman's future, doesn't it? Is this strategic purity, this decision to double down on what they do best, a sustainable path to victory? Or is it just a high-risk bet that the Wall Street cycle of big deals and volatile markets will always work in their favor? I guess only time will tell.